So guys, there are quite a few stocks out there right now whose share prices are seeing more red than a minor threat concert, and while investing when share prices are heading south feels like a scary move, this is exactly what we dividend investors have been waiting for. When share prices go down, it can create some really great opportunities to pick up some more shares of your favorite dividend stocks at a discount. And in this video, we'll be discussing 3 stocks that look like particularly great pickups for your portfolio as we head into March. But before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you have your eye on right now. I'd be curious to hear what you think is looking good. Alright guys, you know we had to talk about the monthly dividend company, Realty Income, whose share prices are down pretty much across all time periods. Just in the last month, Realty Income has seen a decline of about 7.8%, so that's quite a big drop in not a long period of time. And if we zoom out looking at the performance over the last year, they're down even more. They're down 19.1%. And then, zooming out once more, guys, looking at the 5-year performance, across an even longer period of time, they're down about 22%. And most of the hardships for the share price have come just in the last year, and the majority of this is just the same old stuff and has to do with interest rates. Now obviously when it comes to anything related to real estate, debt is a pretty important component. Real estate investment trusts will take on debt and borrow money to buy more properties, which is how they grow, but when interest rates go up, it makes borrowing money more expensive, which cuts into their returns on the deal because they'll have to pay more in interest. And over the last handful of months, there's been a lot of talk about the Federal Reserve lowering interest rates, which would be a good thing for real estate investment trusts, and it seems like investors were banking on that to happen starting here pretty soon, but it's kind of looking like these rate cuts will be delayed a bit longer, which is why we saw a lot of REITs like Realty Income get hit pretty hard in the last month. Like I said earlier, guys, when the share price goes down, it creates a great opportunity to buy these stable, cash-flowing businesses like Realty Income at a discount, which, speaking personally, is exactly what I did with this company. I recently loaded the boat on Realty Income and ended up buying almost 30 shares at what I think is a pretty good price, just under $52 per share, which now, at least for the moment, makes Realty Income the largest position in my portfolio. But anyway, jumping over to the dividend stats and taking a look here at Realty Income's yield, this is coming in nice and high at 5.84%, which in its own right is a pretty juicy yield, but furthermore, this is about 1.25% above the company's 4-year average yield there of 4.6%. So by buying Realty Income today, you're getting a considerably higher cash flow return on your investment. And that brings up an important point that I think is worth knowing for dividend investors. So when it comes to these big blue chip companies like Realty Income here, the dividend yield tends to hover around a certain level over time. And that's kind of why we compare the current yield to the historical average yield. And when the current yield is considerably above the historical average, then it could indicate that the stock is trading at a discount, or it could indicate that the stock is undervalued. And on the other hand, if the dividend yield is below that historical average, then it could indicate that the stock is overvalued. But that's no guarantee. And keep in mind, this is not the end all be all for valuation. This is just one thing that we can look at. But yield aside, guys, there's still a lot to like about Realty Income's dividend stats. With that near 6% yield, you're also getting some pretty consistent dividend growth. I mean, the 5-year growth rate admittedly isn't the highest, coming in at 3.7%, but that growth is consistent and it is dependable. Realty Income's been growing their dividend for the last 25 straight years, which makes them a dividend aristocrat. All in all, I think right now is a great time to consider buying some Realty Income. And like I said, that's something that I'm personally doing, and I'm sure that a lot of you guys out there currently are as well. And if you're one of those people, let me know in the comments below. You know, I actually haven't talked about this company in quite a few months, but I really like Shutterstock. And in case you've never heard of this company before, in a nutshell, Shutterstock is a marketplace for stock images, videos, sounds and music, and 3D models. And they actually have one of the largest libraries of stock content on the internet with over 700 million images, 50 million videos, and 40% of their revenue is recurring, which is awesome. But with that said, guys, Shutterstock has seen quite the dip in share price lately. Just in the last 30 days, they are down a whopping 13.7%. And from what I can tell, there's no specific news that really would have warranted this drop. But anyway, if we zoom out over the last year, the share price has been nearly cut in half, guys. In this time period, it's down 41.4%. And as I'm sure you can imagine, with this considerable drop in share price, that's going to leave the dividend yield right now considerably above the historical average. And that certainly looks to be the case here, guys. Right now, the forward yield of 2.7% is about 78% above the 4-year average yield, so that's quite a big difference. With that said though, for this company in particular, it might not make the most sense to compare the current yield to the 4-year average or the 5-year average, because in reality, the company's only been paying a dividend for the last 3 straight years, so they really haven't had enough time to establish a historical yield. And the same is true when it comes to the dividend growth. As you can see, there's no 5-year dividend growth CAGR, there's no 10-year dividend growth CAGR, but what they've done so far in the last 3 years has been very impressive. The CAGR here is 16.7%, so nice and high, and they just announced another double-digit dividend raise last month, so Shutterstock is shaping up to be a pretty solid dividend growth stock so far. All right, guys, now this one's kind of a wild card. It's a really good looking company though, and in case you've never heard of AGCO, this company is a manufacturer of agricultural equipment. So they make things like tractors, watering systems, feed storages, stuff like that. And earlier this month, AGCO reported a miss on both the top and bottom line in their quarterly earnings, which knocked the share price down quite a bit. Just in the last month, AGCO is down 10%, so another big drop from these guys. And if we zoom out looking at the performance over the last year, that drop is about doubled, and they're down 19.5%, which puts them right there at their 52-week low. And then looking at the dividend stats here, starting with the yield, this is not going to be the highest yield by any means. It's only 1.08%, but once again, with that drop in share price, it's sitting quite a bit above the 5-year average, about 31.25% above the average yield of 0.8%. And even though the yield on this bad boy isn't going to be the highest, the rest of the dividend stats, guys, are looking just... it's incredible. Starting here with the payout ratio, this is one of the lowest payout ratios I think I've ever seen, only 7%. It's very rare that you see a payout ratio in the single digits below 10% or even 20%, but either way, there's plenty of wiggle room here. I love to see that. And the 5-year growth rate is looking juicy as well, 14%. And they've been growing this dividend for the last 10 straight years, so there is some consistency as well. But anyway, guys, AGCO is another great dividend growth stock to consider, and I actually think all of these companies are really solid contenders if you're looking to make some additions to your portfolio. But with that, there are still quite a few companies out there that I think you need to keep your eye on. The first of which is gonna be APD, Air Products and Chemicals, who've seen a drop of about 12% in the last 30 days, and you can see they really fell off a cliff right here after reporting their quarterly earnings. But in the last year, guys, APD is down 17.3%, so definitely keep your eye on this one. Next up, keep your eye on AWR. I think we talked about this one in last month's video, but just in the last 30 days, they are down another 4.6%, and in the last year, they've seen a drop of 20.6%, and they're right there at their 52-week low. And then, my friends, keep your eye on BMY, Bristol Myers Squibb, who's actually seen a little bit of a gain in the last month. They're up just over 2%, but if we zoom out looking at the performance over the last year, they are down a hefty 28%. Anyway, next up, guys, keep your eye on DLB, Dolby Laboratories, which is a company I actually really like. If you guys ever get the time, I highly recommend you do a deep dive on this one. I think you'll like what you see. But in the last month, they're down 6.4%, so quite a steep drop there. And in the last year, they're down actually not too much. They're only down about 3%. So all of their losses and then some in the last year have come just in the last 30 days. Anyway, guys, moving on to the next one, we've got General Mills, ticker symbol GIS here, who is up a little bit in the last month. They're up close to 3%, but if we zoom out looking at the last year, they are down 19%. Anyway, next up, guys, keep your eye on Humana, which is a stock that just does not seem like it's been able to catch a break lately. In the last month, they're down another 8.4%. So a pretty big drop there, and then over the last year, they're down about 27%. So once again, across all time periods, Humana's down quite a bit. And then, guys, another one that I think is worth watching is Starbucks. I've personally been buying this one as well, just kind of been dollar cost averaging into it over the last month and a half or 2 months or so. And in the last 30 days, it's up 2.3%, so they've seen a little bit of a gain here. But in the last year, Starbucks is still down almost 9%. So, you know, could be a good one to buy on a little dip there. And with that, guys, moving on to this next one, we've got UGI, who's seen a nice gain in the last month. They're up almost 8% just in the last 30 days, which is kind of the opposite of what we've seen with pretty much all these other stocks. But still, in the last year, UGI is down a whopping 36%. So still discounted from that point of view and could be one to keep an eye on. And then along with that is another company, one in my portfolio too, that just cannot seem to catch a break, guys. WP Carey, in the last month, they're down down another 14.5%, which does sting a little bit. And then in the last year, they are down just about 30%. But anyway, those are all of the stocks that I think look like good buys right now. And if you want to learn about some other great stocks that I'm personally buying, then check out this next video right over here. I recently just went on a huge dividend stock shopping spree. And in this video, I'm telling you about the 5 stocks that I just absolutely loaded the boat on. So click right over here to find out which ones they are, and I'll see you in the next one.